Sometimes we just need that emergency cash. Other times we're just looking for the best place to borrow and utilize our debt for some purchases. In any event, I'm going to share with you a couple different places I usually look towards to generate that cash. Stay tuned. Okay, so when you're strapped on cash, maybe you're completely fully invested and we haven't started a distribution strategy, or you're saving like crazy and you just need a little bit extra to get you over the line for that future purchase. Well, I wanted to go through a couple different options about where you can turn to generate that extra cash. Now, keep in mind, the whole idea behind taking on debt is to achieve something in the long run, whether it's to do that renovation in your house, maybe to pay that tax bill that just came due, knowing that you have some income coming in the next couple of months. Whatever it may be, some of these options can provide some nice financing for you in order to keep some things invested or to not completely turn to credit cards or like a payday loan where you're getting really hammered on interest. One of the first ones that we often talk about in meetings or just as we're getting ready for retirement is to open up a home equity line of credit. Now, the home equity line of credit is the ability for you, if you own your house, you have equity in your house, to basically go to a bank or a credit union. It doesn't have to be the servicer of your loan, but you can reach out, find where the best interest rate may be, which, look at websites like bankrate.com. And you can go to them and say, hey, I would like to tap into my equity as a way to pay for something. In most cases, when you're getting a home equity line of credit, it's going to be for either healthcare expenses, some kind of home renovation project, or maybe you just need some emergency cash. And so this can be a very nice option because it provides you a very good interest rate in comparison to some other tools or options. So with the home equity line of credit, one of the best tips is to get this established before you retire. So if you're approaching retirement, one of the ways you can do this is just reach out to a bank or credit union that you're already banking at and say, hey, what are the current interest rates, or what are you offering in terms for a HELOC? I'd like to take one out. So one of the cool things about the line of credit is you can go to the bank, credit union, wherever, and ask for them to set this equity line up. And you don't have to necessarily draw upon that equity line. For example, if it turns out you don't need that extra cash, then you've just established this line of credit for future use. And if you never end up using it, then there you go. And then it's done and dusted, so to speak. There is a small fee to get this thing set up, maybe anywhere from $500 to $1,000. Just depends on who the provider is. However, it's a nice option because, again, you have the ability to draw upon it if you need it. And as you pay it back, you only pay for what you've taken out. So it's not a loan where you've taken out $50,000 and you have to start paying that principal and interest back. Well, at the home equity line, you've essentially opened up the equity from your house in order to draw down from it and pay it back at a later date. And typically how they work is once you start drawing down the equity, for example, let's say $50,000, you have $50,000. The short form of a home equity line of credit is called a HELOC. So when you establish the HELOC, let's say you got $50,000 set up. If you take down $10,000 of that $50,000, the company will require you to start making interest, what they call interest-only payments to them. And in this example, if your interest rate, most interest rates on HELOCs are variable, they're going to be a form of the prime rate. And it'll be right now probably around 3.5% to 4%. And so you'll pay the interest back just on what you've taken out. Again, you're not paying the principal at this point. You can basically pull out the funds, $10,000, and just pay interest on that $10,000. And then at a certain point in the future, it basically flips, it turns on, the HELOC's window starts, and you have to start paying the principal back. And that's all within the terms and All the terms are different regarding the payback. Typically, it's you have this window of 5 years that you can draw down, or 10 years that you can draw down, and then it's interest only for 5 years, and you have to pay it back over 10 years. So there's a lot of nuances to it. However, it does provide you a really nice option, because in most cases, you're not going to tap into your home equity. Maybe now, maybe never, right? Until you're dead and gone, you've passed that property down to someone, or in the future you look to sell it. It's a nice way to kind of utilize that asset to pay for some things. So again, a very valuable tool, the home equity line of credit. It's a very nice interest rate. It usually takes somewhere around 30 to 45 days to establish. So keep that in mind, that if you need cash fast, it's going to take some time to get this thing up and running. Now, one of the other ones to consider before you're retired may be a 401k loan. So most employers offer some version of a 401k. And if you have money already set aside into your 401k, you can technically borrow from that 401k. And it's not going to count as taxable income to you unless you leave the company with a loan and you don't pay that loan back. However, it can function as similar to the HELOC in that you can take money out and use it to pay for some of the things that you need. And so it becomes another nice way, because the limit is only $50,000, and so that may be a good or bad thing. However, when you're pulling the money out, you're taking money out of your retirement account, and as you're paying it back to yourself, right? So you're not technically paying back another company. You're putting the money directly back into your 401k. There is an interest rate that you are paying yourself back, which is just like the HELOC rate. It's based on the prime rate, and they usually add maybe 1% on top of that. And so again, it can function as a really nice way for you to generate that emergency cash if you need it in a pinch. And the 401k can be pretty quickly set up depending on the provider, your employer. And in most cases, a 401k will offer some kind of loan feature. There may be a small fee involved in that, maybe less than $200. Again, it just depends on the company and what they offer. Now, companies don't have to offer a loan feature, they call it, to the 401k. So you have to check the documents, what they call the SPD, the summary plan description, to see if it's offered. However, in most cases, most employers, if they have a 401k, they are able to offer a 401k loan. So again, the downside with the 401k loan is the max is only $50,000. The HELOC is going to be a lot higher maximum, especially if you have a house in Orange County and you have a lot of equity. That limit will fluctuate, but it'll most likely be higher than, for example, this 401k loan, where you're limited to $50,000. The other downside to the 401k loan, as I mentioned, is if you leave the company before you've paid back the loan, then you essentially could get hit with the remaining amount as a distribution. So for example, if you take out $50,000 for a 401k loan and the next month your employer lets you go, well, you have to put that $50,000 back into the plan. Otherwise, it's going to count as if you received $50,000 paycheck. So it's going to be counted as taxable to you, and that can be a burden if your job situation is uncertain. You don't know what's going to happen. You want to minimize that by kind of having some kind of future outlook to see, okay, I'm probably going to be here for a while. Therefore, that basically can turn into a non-event. One of the other options, which I've talked about in a previous video, is a 0% interest credit card. The idea of leveraging that to get some short-term financing set up, right? Whether it's, again, a home renovation, you got to pay for some medical bills, they'll accept the credit card. Knowing that you have some cash flow coming later down the road, or that you're just in a pinch and you need some cash, knowing you can save, in the months ahead to pay this off. A 0% interest credit card can be a very valuable tool. Again, think about if you're going to apply for one of these, or if you're trying to get one of these, it could take, a week to 2 weeks to physically get the card, get the card number to be able to apply that towards whatever you're trying to apply it towards. So the downside on the credit card is going through the process of getting approval, getting the card, and making sure it's timely in the time frame that you need it. Other than that, there's not a lot of downside other than the fact that if you don't pay this thing off, in most cases, these cards, the interest rates will start really high, right? So 0% interest credit card, again, you can take out a 0% interest credit card. Typically, that interest rate will be for 12, maybe 18 months. So you don't have any interest payments. You still have to pay it off at the end of that term. Otherwise, the interest rate will start, and it's usually pretty high, somewhere around 15 or 18%, right, depending on your credit. And then at that point, if you have a large balance and that interest rate is being applied to that balance, you're going to put yourself in a really tough bind, because all of a sudden you're not going to be able to pay that principal off because the interest rates are just the interest payments are going to be just too overbearing and are going to absolutely crush you. So the 0% interest credit card can be a really nice solution. However, you have to be certain that you're going to pay it off. Otherwise, it turns out to be a really bad play. And lastly, one of the lesser known options is an IRA 60-day rollover. So what does that mean? That is you taking a distribution from your IRA, typically in retirement. You take a distribution, let's say $20,000. You have to put that $20,000 back into your IRA within 60 days. Otherwise, it gets counted as a distribution to you, and therefore it's going to go on your tax return and it's going to be taxable. And so the 60-day rollover is a little nuance within the IRS code that allows you to essentially take a really quick loan from your own IRA to put the money then back into your IRA and not be taxed on it. So again, a really nice way to kind of generate some quick cash. This one comes with the caveat that you may have to sell some investments in order to do so, which typically is not ideal depending on where the market is and where the economic cycle is. However, it can provide you with some really nice short-term financing. And keep in mind, this can only be done once a year, and you have to make sure that the reporting at the end of the year is all buttoned up, because we have seen some issues where some of the tax reporting hasn't been accurate. So you have to go back and make sure things are accurate, that this distribution doesn't get applied towards your taxes, and therefore it's a non-taxable event. So what do all of these have in common? Well, all of these options have in common is a low interest rate, right? In some cases, 0% interest rate if it's a credit card or an IRA distribution. They allow you some of this emergency cash if you don't have cash on hand, or if you're running cash light because you've been doing a lot of different things, right? So it gives you some flexibility, and it gives you some options to choose from, rather than just saying, hey, I'm going to take a distribution from an investment account, and whether it's taxable or not, whether I take money out of the market or not, I don't care. Well, in this case, these options allow you some flexibility, because we know in life nothing's perfect, right? Healthcare expenses can really trip us up. Car repairs, whether it's house repairs, right? All those different things can really affect our cash flow. And if we don't have emergency cash, or we've used up all of our emergency cash, these can become some really nice options to utilize to make sure that we're not completely derailing our financial plan, or to make sure that we're being very smart about how we're generating cash. Because the idea is these tools are out there, and if you can leverage them, it's a smarter way than just saying, hey, I'm going to go take a payday loan, or I'm going to take out just a regular credit card and put everything on my credit card, right? Learn how to find these options, manage the situation a little bit better, talk to an advisor. We always have some of these options in mind if that's what you're running into or running up against. And so make sure you're thinking about all these things and not just rushing out to say, I need to generate cash, I need to do something really quick in order to do that. You most likely have some options. I think this topic has been on my mind a lot so recently, typically around tax time, when maybe there's a surprise tax bill that we weren't anticipating, or there's a tax bill along with something else, and we need to generate some quick cash, right? There's a lot of options out there, so make sure that you're reaching out to us, letting us know if you're running into some of those things. We want to help you find a solution. So I hope this was helpful. If it is, please please subscribe, share with your friends. If you have other topics or questions you have, send them our way. We'd love to address those or create a video or a podcast about them. Please have a great day and enjoy your weekend. Take care.